Hi, I'm Jared Nelson from the Investing Channel, and welcome to Markets and Minds, the show where we break down big macro themes into simplified trade ideas. Last week was an interesting period in the equity markets, and much of the conversation amongst professional and retail traders alike has been about valuation, including what's justified and what isn't, and there was certainly plenty of fuel to fire this debate. For example, last week saw the debut of cryptocurrency exchange and custodian Coinbase Global, which came to the market via direct listing without raising fresh cash to achieve a valuation of $100 billion. That is an extraordinary figure for any business to achieve, but for one that was only started in 2012, it's quite incredible. What is even more amazing, however, is that this valuation is greater than that of the world's largest exchange operator, the CME Group Incorporated, whose market cap is a fraction under $75 billion. The CME has a 170-year track record. It effectively invented financial futures and manages the exchanges on which some of the world's most active financial products are traded. It has annual sales of almost $4.9 billion and an annual income of $2.1 billion. Now, of course, beauty, or in this case valuation, is always in the eye of the beholder, and Coinbase's valuation has been driven by venture capital backers who have put money into the business prior to its listing. The valuation is also a function of the future expectations and time horizons of investors who have bought into the stock since it listed, among whom are Cathie Wood and her ARK Invest group, who have made a name for themselves by buying into and holding on to technology stocks. To buy into the Coinbase valuation, you need to believe that the business can grow and grow quicker than mature rivals such as the CME. Coinbase is one of the largest cryptocurrency exchanges in the world and is trying to expand into the institutional market to diversify its revenues away from its largely retail client base. The CME, of course, operates the principal market in Bitcoin futures and has recently introduced contracts over Ethereum as well. What's more, it will shortly introduce micro-contracts on Bitcoin. These will be 1/10 the size of the standard Bitcoin futures and are squarely aimed at the retail space. The debate about valuation is often at its most intense at the point where new technologies and ideas come up against established systems and industries. The most obvious example of these in recent times has been in the electric vehicle space. The poster child for the sector, Tesla, was at one point valued at more than all of the world's other automotive manufacturers combined, despite Tesla making and selling only a fraction of the number of vehicles they did. The sector has had a number of high-profile startups whose business models and valuations have been called into question. Last year, electric truck maker Nikola was on the verge of securing a $2 billion investment from GM and was valued at as much as $26 billion. However, a damaging report from a renowned short seller published in September last year exposed numerous issues at the business. That led to the resignation of the company's founder and chairman and to the cancellation of the GM deal. Nikola's current market cap is just over $4.3 billion. And in the same sector last week, we saw EV battery manufacturers QuantumScape come under a similar pressure, as another short seller published allegations against the company, which saw its share price fall by -15%. QuantumScape itself was on the verge of securing the first of a series of $100 million investments from Volkswagen, who want to develop the next generation of automotive battery power cells. The report claimed that these batteries were a decade away from being developed, if indeed they were possible at all. Investing in new technology and new ideas always requires a leap of faith, whether that's as an early adopter of new consumer electronics or buying into growth companies. The trick for investors is not to let their enthusiasm for new technology and change blind them to the realities of the situation. We do live in an age of disruption and innovation, but the old adage that if something looks too good to be true, then it probably is still valid. The idea of a new paradigm is often advanced to justify high valuations, but it's not for nothing that the phrase, "this time it's different," has been described as the 4 most dangerous words in investing. When it comes to investing in technology and growth stocks, professional traders and retail traders alike need to keep their feet on the ground and separate their emotions from their investments. They need to try to focus on what's realistic and what isn't, and to work out what share price the feasible part of a business justifies and how that compares to the current valuation, and they can then make an informed choice. That's all we have time for this week. Please make sure you do your own due diligence before making any investment decisions.